What if I told you that the richest people don't work harder than you do? They just make their money work while they sleep? Today, I'm going to give you some tips on how to invest your money for long-term growth. And no, it's not just putting your money anywhere with the aim of expecting some huge results. Welcome back to this channel, where I break down what you need to know about your personal finance. If you are new here, we make complex money stuff really simple, including a way out to the finance obstacles. Hit subscribe if you don't want to stay broke watching this later. Alright, imagine you have just received your monthly salary from your boss. Let me guess how you will spend it. Option 1. You spend it on an existing debt and use the rest to sort your expenses. Then half of the money is gone. You get a meal, a pair of shoes, it's done. That's consumption. You have exhausted your money into things that make you less satisfied. After eating your dinner, you lay on the bed thinking what to do with the remaining amount left in your bank account. Then you remembered saving it for future purposes. This is a normal way 80% of people live their life and still wonder why their life feels stuck with no improvement in their finances. To change that, think of it this way. What if you give 30% of the salary to something that can grow it? To invest it. You might be thinking this is another wrong way to tackle your problem because you have probably tested it before and it failed. On that fateful day, you received your salary as usual. You take a plunge and put a little amount into a stock market and boom, everything went down. I know that kind of feeling looking at the phone and seeing the red flags. The money has vanished and you are sad. Yeah, that is how it usually happens, not just to only you, but to all the beginners who have little knowledge about investment. Before diving properly into investment, we all need to know what investment is. Investment is putting money, time, or effort into something now with the expectation that it will give you more value back later in the future. This is the core idea. You give up something certain today to achieve something bigger and more useful in the future. Examples. You put your money to buy a share of a company. If the company grows, your dividend increases. It is that simple to note down. The real deal is how to grow money with the use of investment. That's where the problem lies. At first, people rush into investment with the mindset to gain quick profit, but they eventually rush out when they realize how difficult it is. Before any further step, you need to invest firstly in yourself. This is the number one step any individual must take before thinking of investing their money. You are not well grounded with knowledge. How do you want to proceed to success? Many beginners stuff a series of poor tutorials into their head and they think it's time to go into the right deal. Absolutely no. You have to take your time to learn from both books, mentors, and others' mistakes before you decide to start. The second step is to have the longer-term timing mindset. Long-term growth works better when it comes to profit. Take a look at it this way. If you invested $1,000 for 20 years, you will probably receive a profit of $6,720 over the course of 20 years. What does this mean? It means the longer your money stays at the investment project, the more it keeps bringing revenue to you. New investors have quick expectations on the arrival of their revenue, which makes them take uncalculated high risk. This scheme requires a lot of patience and solid strategies to stand out. For a beginner who is starting with a low capital, it is often advisable not to expect any huge return as fast as possible. Give it time to mature so you can reap what you sow in bulk. Moving into the third step, which is to set the foundation. During your early experience, after getting your first revenue, you might want to invest as much as possible to get more higher returns in the future, and this is very unwise when you know that the capital is way too much than expected. The market is unpredictable, so do not invest what you cannot afford to lose. At this stage, you need to lay low. These are the times of learning from one's progress and mistakes. You still need that capital to keep you moving gradually from all these stages. A friend earned his first profit of $1,120 after investing $800 for just 2.5 months. He thinks it is an opportunity to keep investing to receive more. Then he invested back his money. After a couple of months, the program reduced to 16% from 40%. So what should you have done in my friend's position? Simple. Take some profit off the table. Reinvest a portion, keep the rest safe. Because here is the truth nobody tells beginners. The market giveth, and the market taketh. It doesn't care about anyone's situation. It can climb and drop to any extent. That is why before you even look at a single stock chart, you need to build your foundation first. And I mean a real one. 3 things you need to look at. The emergency fund. Clear your bad debt. Then invest. Your emergency fund should cover at least 3 months of your living expenses. That means if everything goes wrong tomorrow, like you lose your job, make sure you are not forced to pull your investment out at the worst possible time. Because that is exactly when people do the panic sell and lose everything in the long run. Next, if you have any debt which is charging you more than 15% interest, pay those off first. Because no investment consistently pays 15% guaranteed returns. Paying off that debt is also an investment. You have blocked one channel that later costs you money. Once those 2 boxes are checked, now we can talk about putting your money to work. Which leads us into step 4. Pick the right investment platform. Now this is the part where most beginners go wrong. They think investing means picking the next big company and riding it to the top of the moon. Let me save you years of frustration. Long-term growth, boring wins. It would look like nothing significant is progressing. That is where the success starts from. Let me help you out with a series of trusted investment platforms you can try for starters. Although profit and losses vary depending on the individual. Option 1, index funds and ETFs. An index fund is basically a basket that holds tiny pieces of hundreds or even thousands of companies at once. When you buy one unit of an S&P 500 ETF, for example, you are automatically owning a small slice of the 500 biggest companies well recognized in the society. Think of it this way. Instead of betting on one player to win the World Cup, you are betting on football itself. And historically, football always wins. The fees are low. The diversification is automatic. And over the last 30 years, the S&P 500 has averaged roughly 10% returns annually. That is the vehicle 90% of people watching this should be using. Option 2, mutual funds. Similar idea, but a fund manager is actively picking the stocks instead of just tracking the market. Sounds smarter, right? Here is the catch. The fees are higher, and most active fund managers still underperform the index over a 10-year period. So you are paying more for less. Not saying avoid them entirely, but always check the expense ratio before you commit. Option 3, individual stocks. This is for people who have done their research, understand financial statements, and can handle high volatility without blinking. If that is not you right now, that is okay. It does not need to be. You can build serious wealth without ever picking a single stock. On to the next, which is step 5, the strategy that removes emotion. Now, you know what to invest in. But how do you invest without stressing yourself every time the market moves? 2 words, dollar cost averaging. Here is how it works. Let us say you decide to invest $200 every single month. No matter what the market is doing, whether it is up, whether it is down, whether people on Twitter are screaming that the economy is collapsing, still you invest that fixed amount every month. Like clockwork. When prices are low, your money buys more units. When prices are high, it buys fewer. Over time, it all averages out, and you completely eliminate the stress of trying to predict the perfect moment to buy. Because here is the secret the pros know. Nobody, not even hedge funds, not Wall Street analysts, not your brilliant uncle who thinks he knows. Nobody can consistently time the market. But time in the market, that is where the real money is made. Set it up as an automatic transfer and take the stress off your shoulders. The automated deposit will definitely keep your money enrolled in the market while reducing the risk of deposit forgetfulness. Treat it like a bill you have to pay yourself first. You will not even miss it after the first 2 months. Nevertheless, this does not still guarantee total success if you are not ready to address the things I am about to tell you in step 6. Things that will kill your growth. Alright, we are getting closer to being an educated investor. So let me give you the 3 biggest mistakes that quietly destroy people's long-term returns. Number 1, panic selling. The market will drop. I am not saying if, I am saying when. There will be a year where you open your mobile phone to check your investment only to see your portfolio is down 15, maybe 20%. Your chest will tighten. Your brain will scream, "Get out now," before it gets worse. You are at the panic stage, confused about what to do. All you can think of is to back out. Do not listen to it. Yeah, you heard me right. That thought, do not listen to it. Every single market crash in history has eventually recovered and gone on to hit new highs. The people who lost money permanently were the ones who sold at the bottom out of fear. The ones who held on and kept buying later came out richer on the other side. Don't let your emotions decide for you. The market is way too smart that it can tamper with your thinking. All you just have to do is hold on and figure the right decision. Number 2. High fees. This one is silent but deadly. The difference between a fund charging 2% annually versus one charging 0.1% sounds small. But over 30 years on a $100,000 investment, that difference can cost you hundreds of thousands in lost returns. Always check what you are paying. Number 3. Chasing hype. Every few months, there is a new thing, a meme coin, a hot new stock everyone is talking about on social media, some get-rich-quick token promising 10,000% in returns. That is not investing. That is gambling dressed up in financial language. If your reason for buying something is because you saw it trending, that is a red flag, not a green one. You should consider that a no-go area. What does long-term actually mean? Before I give you your action plan, I need to set one expectation straight. Long-term means at least 10 years, ideally 20 or more when it comes to the perspective of investing. Expect average annual returns of around 7 to 10% in a diversified stock portfolio. Some years, you will be up 20%. Some years, you will be down 15%. That is normal. That is the deal. If you need this money in the next 2 or 3 years, especially for rent, for school fees, or a wedding, please do not put in stocks. That is not what this vehicle is built for. Use a high-yield savings account or a short-term bond for money you will need soon. But money you can genuinely leave untouched for a decade or more. Plant it, water it monthly, and leave it alone for it to grow as desired. Your action plan due this week. No more overthinking. Here is exactly what to do. First, open a brokerage account. Depending on where you are located, if you are international, you can go for Interactive Brokers or Fidelity. They are solid options when it comes to stock investment. After enrolling yourself in an investment platform, set up a fixed monthly automatic transfer into your investment account. Even if it is small, start somewhere and have the mindset you will scale up. After that, buy one broad market ETF, something like the Vanguard S&P 500 ETF or an MSCI World Fund. One fund. That is it. Do not overthink it. Then leave it untouched. For real, do not touch it. Set a reminder to review it once a year, not once a week. It will save you from frequent panic and obsession over sudden growth. This is all you need to independently invest your money to amount to wealth without getting missed out. Once again, the overview is: build a solid foundation, pick an ultimate index fund, automate the process, ignore the noise. That is the entire strategy. Look, as we all know, investing can feel overwhelming when you are just starting out. But the biggest mistake you can make is waiting until you feel ready. You will never feel ready. Start small, stay consistent, and let time do the heavy lifting. The richest people in the world are not smarter than you. They just started earlier and stayed in longer. So start today, even if it is a tiny amount. If this video helped you, do me a favor, like and drop a comment below. Subscribe if you want more educational videos like this, and I will see you in the next one. Thanks for watching.